The information in this podcast is current on the day of recording. It is general advice only and does not take your personal situation into account. It may not be suitable for you. Participants in this podcast may also own the stocks discussed. For a full list of current recommendations and stocks owned by staff, members of Intelligent Investor can visit www.intelligentinvestor.com.au.
Welcome to Stock Take. My name's Gaurav Sodhi. Joining me today are analysts Mickey Mordek. Hello, Mickey.
Hi, Gaurav.
And with us also is James Carlisle. Hey, James.
Good morning.
Gents, another reporting season over. From my point of view, I thought this was maybe the best reporting season I've seen in living memory. There were so many better than expected results, some huge share price movements, lots of disappointments as well. But still, I'd call this still one of the best ones I've seen. JC, you've seen probably more than anyone else. What do you reckon?
Well, I think, thanks. For
Yes.
that. A bit older than everyone else. It's all relative to expectations, I think, is the main point, isn't it? So, back to pre-COVID levels is a refrain that I was hearing quite frequently. And I think that tells you something, when companies are shouting from the rooftops that they're back to where they were a year ago. In the scheme of things, that's a fantastic performance, and that's why everyone's been so delighted. But for a lot of companies, but in the normal run of things, I wouldn't call that fantastic. But in the circumstances, a lot of companies have done far better than expected. The pandemic has hit a number of sectors very, very hard, particularly in this country where we've had the sort of closed borders, but international borders, well, and some internally. But the rest of the economy has sort of kind of moved along relatively normally. So the sort of the travel sectors and the hospitality and things directly affected by lockdowns and some of the stuff that's got higher exposure to Victoria. But there are some sectors that have done, really, really well. An obvious one is pizzas. We'll come to that. Pizza delivery, that goes well in a pandemic. And retail, some sort of specialists, people setting up their home offices and homewares, those sorts of things. Groceries, of course, Woolies and Coles have had fabulous 6 months. So it's been sort of very mixed, I suppose.
Yeah, anything online has just rocketed, hasn't it? I've been a bit surprised by the sustainability of the online boom. I would have thought things like Kogan and Temple and Webster would have subsided a bit, but they've fired on. And JB Hi-Fi probably has been one of the most surprising businesses of the last year or so for me. I think it's just highlighted what a very good quality management that is. It's been able to be extremely flexible as demand changes, but also how in that industry there's no competition for them. I know Harvey Norman is there, but Harvey Norman makes most of its sales from furniture
Does
and other
other
things.
things. Yeah, that's right. It's not. I think as we go into the online sort of age, that's a bit of a tired expression, isn't it? But I think specialization is what's really going to happen more and more. I mean, even JB Hi-Fi is actually a bit sort of spread out, I would suggest, but it's much more specialized than the likes of Harvey Norman. Yeah.
Mickey, how did you see things?
Well, similar to retail analyst James Carlisle, really.
Heaven forbid.
We have a running joke because James is not the
Can't do
retail
retail.
analyst.
Retail's hard. Well, I do Coles and Woolies,
but you seem to
different.
actually do a pretty good job of them, though.
Well, but the non-discretionary is a little bit easier than the. I'm not very good at fads and fashions. Put it like that.
Yeah.
You should see me on a Friday night.
I saw it in similar terms. I guess it was all about expectations. And last March, I think no one really knew how things were going to pan out. As it's turned out, probably the government intervention has really probably done what it was designed to do, and that's helped a lot of businesses not only survive but record, in some cases, record results. So it looks like things are things are better than expected, and it probably bodes pretty well for the next year or two as well as things do recover. And there's probably still lots of upside in some of the more cyclical stocks that are due to hopefully report better results as the economy continues improving.
And the thing about the intervention is that the companies don't particularly pay for that. It'll be paid for in future years through taxation, and that might depress growth a little. But when you depress growth, you also depress interest rates, and it's been the lower interest rates which have kind of driven stock prices the last 6 months, to a year. I mean, the bond yields have gone up in the last few months, but they're still a long way below where they were a year ago. And so the companies sort of get the benefit from that bump in spending, but their valuations don't necessarily pay for it.
Yeah, we're sort of just in this world now where the government just bails out corporations, and it's just socialized losses. So that's probably a good thing if you're in the stock market, really.
Well, also if you've got a job, I mean, so
yeah.
So I thought we should run around and do a couple of the best results that we saw each. You can throw in something awful if it turns up as well. I've certainly got one of those. But JC, let's start with you. What were some of the highlights of your reporting season?
Well, first on my list, which I've already touched on, Domino's. So here's a question. Domino's Pizza Enterprises, the ASX listed company, has the most stores in which country? That's your starter for 10.
Well, it can't be Australia because that's the obvious answer, and you wouldn't have asked the question.
Well, it could be. Don't spoil it. You'd expect it to be, right?
You would expect it to be, yeah. That's right. Because they got 1,000 stores in Australia, right? 1,200 stores?
846
yeah, right,
in ANZ. So I'm not actually sure how many there are in New Zealand, but let's guess there's about 600 in Australia. 742 in Japan.
Oh, they got 700.
Actually, it must be more than that in Australia because they've actually Japan's just passed Australia this half. So 742 in Japan. I think they added 60 in the half. And then just for completeness, Europe has about 1,200, with roughly evenly split between France, Germany, and Benelux. So Japan now, the largest number of stores, and interestingly enough, it has a much greater share of company-owned stores. So half of those stores in Japan pretty much are company-owned, compared to about 10% elsewhere, which is an interesting difference in the models, and I'm not quite sure why that is. But it has some significant effects on the financials because the company-owned stores, basically the company sort of takes the risk of stocking them, and they don't have to pay the employees as much because the employees don't need the incentivization and all that of a franchise store. So they get bigger margins in Japan as a result of these company-owned stores, and stronger cash flow, especially when they're growing and building negative cash flow. So Japan now has the most stores, the highest margins, and pretty soon it's going to be, I would guess, within the next year or so, it's going to be contributing the most profit.
Yeah. And they still got a long way to go before they match the congestion ratios, right? The people per store ratios that we have.
Yeah, that's right. So in Japan, it's I forget the exact number. I think they have about 170,000 people per store in Japan. It's about 140,000 in Europe, and I think it's about 40,000 in Australia. So the density is much. They've got much greater scope to add stores in Japan and Europe, for that matter, and they're growing pretty well in Germany as well, I should add.
What an amazing success story. I remember when they first opened in Japan, people laughed at them. I remember a lot of sniggers and, the Japanese don't eat pizza. Doesn't everyone know that?
Yeah.
And in fact, the first few years, they were losing money until they sent their senior management from Australia to live in Japan for a few years. And while they were there, they tweaked the formula, and I think they changed a lot of the menu items for more specific Japanese tastes, and that
Yeah,
seems to have
yeah,
triggered a lot of success after that.
yeah, yeah. And they changed the management in Japan. I don't know if this was associated with that, living in Japan for a couple of years, but they changed the management in Japan in 2019. And obviously that has coincided with a big improvement. So, I mean, the thing about Japan is I guess they have very different tastes, I suppose, at least in fast food. But they also do tend to embrace, I think they embrace everything, but they embrace Western culture in a particular way, don't they? And I guess pizzas are a part of that.
I understand that Japanese pizza consumption used to be on specific special occasions, and they've managed to actually increase the frequency of store visits for their customers. I'm not quite sure how they've done that. Must be through marketing, might suggest, but
Yeah, or just more special occasions. I'm not convinced that they order it for a Friday night meal as much
yeah.
as people do in the West. But as you say, so I think it's a question of changing behaviors to a degree. But they've also, I think, rolled out some of the new technology there first. So they got the 10-minute delivery times there first, and I think the Japanese obviously appreciate that. So more than anything, I think it's just been execution. As you talked about the menu, improving, delivery times, and so really it's a question of operational excellence. And as you say, there's a long way to go. So the one of the key things which I noticed when I started covering Domino's last year was this fortressing strategy they talk about, whereby they essentially cannibalize their own sales by putting new stores sort of right in the middle of sort of an existing store network. And that's the hallmark of a lot of great companies have done that over the years. Apple being the most obvious example, by pretty much completely killing off its iPod with the iPhone. And the fortressing strategy, it's probably quite a hard sell to franchisees because when you put a new store just a mile down the road from one of your existing ones, they're going to be a little bit worried. But it really improves quality. It reduces delivery times, means people get, that means the pizza arrives hotter and crispier. And so the overall experience is much better. The stores also sort of sell themselves because you see the Domino's up on the side of the road. That's one of their best bits of marketing and essentially comes for free.
I think the evidence is that it actually expands the market for the pizza. They've done this in the US as well. The Domino's, the master brand, has done that in the US, and it's done wonders.
It keeps it front of mind. Yeah, that's right. It keeps it front of mind because people see the stores, but it also makes it very, very hard for the the aggregators, the Uber Eats and people, the Deliveroos, because they have to send someone to the store to get the pizza, and it's almost impossible for them to compete.
Absolutely,
with 10-minute
they're effectively
delivery
replicating
times.
the delivery network, aren't they?
Yeah, well, which they can't do, So there's no way they can compete with the 10-minute delivery times. Why would you order a Domino's pizza or anyone else's pizza from Deliveroo when it's going to take half an hour to get to you when you get it in 10 minutes from Domino's?
Yeah.
And that's all enhanced by the fortressing strategy. And going back to Japan, with one store per 170,000, they've got a lot more scope to do that over there.
What really stood out for me for Domino's, I actually thought Domino's was one of the best results of the season. I'm really glad you brought that one up. I was stunned by the sheer amount of growth still on the table. Even in Australia, where, as you say, almost 1,000 stores, they can actually, I think they talked about a 30% still increase in the store network in Australia. And in Europe and Japan, they're talking about adding multiples of the store size, so thousands of stores still to come. So in 10 years from now, you're still probably going to see higher store counts. There's years and years of more store growth to come from them.
Yeah, particularly in Japan and Europe, I see a very long runway for growth, and that's why the stock is priced so expensively. But we took the opportunity to bump up the price guide quite significantly. So we're now not going to sell till it gets to 130. The price promptly dropped. It was about 110 when I wrote up the result, and promptly dropped to 90 or so.
It's funny. Before the result, I own Domino's Pizza, and before the result, I was thinking, okay, a strong result here. I'll probably sell into this result and book some profits.
No, you don't want to
But
do
when the result came out, I completely flipped and turned around. I thought I got to find a way to buy more stock. It was fantastic. Great result.
Yeah, I mean, the only other thing to say about that, though, is that you do want to just watch your portfolio weighting. So, I mean, when a stock, I mean, we recommended it from much lower levels, below $40, I think, was our first upgrade. And so, if you're getting towards that 6% maximum portfolio weighting, it might be worth considering, reducing a little bit. But overall, it's a very, very firm hold.
Mickey, any thoughts on Domino's?
I just don't get why people eat the pizza, but they do.
Oh,
so,
hang on. I've got a story about that, actually, before I set you loose. So we ordered Domino's, which I think we got for $6 a pizza. And in the same week, we ordered crust, which was $20 a pizza.
We have crust here when we have pizza.
I think in terms of, I mean, pizza taste is very subjective. For me, I thought the Domino's was better tasting than the crust. The crust was horrific. But put that aside.
Yeah, it's never very good.
It's awful. It's awful. But put that aside.
What pizzas did you get though? That also.
I think with pizza, vegetarian is always better. I mean, I'm not a vegetarian, but I think when it comes to pizza, I always prefer veggie pizzas. Controversial, yeah.
I reckon.
Send in your complaints. But then when you compare the returns that the businesses, so Crust, as a reminder, is owned by Retail Food Group. Domino's obviously is Domino's. Compare the returns on those two businesses, and Domino's, it looks like, makes about 3 times the return on capital that Retail Food Group does.
And the pizzas are priced
half. So you're effectively Domino's. Well, Retail Food Group, Crust has to compete with a business that charges half its retail price and makes 3 times its return on capital. It's just an impossible business to compete with. I think it's such a strong dominant position with so much growth ahead of it.
Yeah, and I guess Domino's isn't competing with like the local,
no, not anymore.
$20 pizza. They're kind of going for that really cheap, quick experience, basically. Yeah.
Sorry.
Whereas I guess Crust is more so.
I cut you off before. If you have thoughts on Domino's, now would be the time. Otherwise, probably should move on to some other stocks.
Oh no, no thoughts. Yeah, my thoughts are probably defer to JC really, but yeah, sounds like a cracking story. So, but I guess from one Japanese thematic to another, so Servcorp, actually, I thought I'd talk a little bit about that.
That's an awful segue.
Well, now you can tell why your hosting job is not under threat anytime soon. Did someone say Japan? So Servcorp is the provider of shared office space and flexible workspace, and so their operations, basically, that they'll go look for a floor in an office building. And then they will rent that out to small small companies, or kind of contractors, or really small workforces, and they'll charge that out on very short-term leases. And so basically they're renting for the long term, so say 5 or 10 year leases, and then they rent that space out on much shorter term leases for companies that don't have a big demand for space. So coming into the result, I guess most people probably would have thought that these guys would have been absolutely hammered, because probably one of the first expenses you can cut if you're a small business is your office space, and especially if you're just a 1 or 2 person show, you can probably cut back pretty easily, and these are short-term agreements as well. So and that did happen. You did see some of that for these guys. However, they really benefited a lot from having quite a bit of diversification across a few different countries. And so China and Japan in particular came to the rescue. So the lockdowns there were very swift, and they were kind of very short lived. And actually, I don't think Japan ever went into a full lockdown. So,
well, they requested people stay at home, didn't they? They're not. I think the law in Japan says you're not allowed to force people to stay home, but they requested it. I think the result of a sort of national request for people to stay home is pretty much similar in Japan, which is fabulous. Yeah. Anyway.
Yeah. Well, I mean, so well, clearly though, like in this result, it showed that people were still turning up. So like revenue didn't fall at all on the previous half, which is quite in North Asia anyway, which is quite a remarkable result, and probably not something most people would have expected back in March. So,
and what proportion is they define it as North Asia? Do they? Is that what's the split?
Yeah, it's North Asia. I mean, so most of that would be Japan.
And what proportion of that is that of
so Japan would be about 2/3 of Asia, and then Asia is probably now about half of revenue.
Right, but only since the pandemic.
Since the pandemic, but even before the pandemic,
it was pretty substantial, wasn't it?
Yeah, it was almost 40%. So, and it looks like Servcorp's kind of model with like the more upmarket, maybe leather couches and marble floor. Maybe that's more better received, I think, in perhaps some Asian cultures. Whereas I guess like in the West, it's kind of going the other way, where probably in general, people are probably becoming less formal. So, but that's one of the strengths, I guess, of the model, is that they can test these offices out in different markets and roll them out where they're successful, and kind of pull them back. And I guess one of the
they were. The CEO there's had some really big ambitions in the US for a long time. Do they still have a significant American business, or is that gone now?
Yeah, so I was just about to go into that. So,
carry on.
So the US market has been a bit of a problem child, and I guess it's been really unprofitable for a really long period of time, and so there's always been this opportunity that either if they get that division right, or if they just get rid of it, then profits could grow. Just from that, and so finally, what we saw in this result, from the pandemic, is that has now forced them to close a whole bunch of unprofitable US floors, and so the revenue fell, but the profits actually didn't fall any further.
Right.
So
weren't they making losses in the US?
Yeah, they were making losses, and kind of disproportionately. Still are.
But
however,
less,
I think without the pandemic, they may have actually been break even. So they've
Right.
pretty much gotten rid of all the floors that were losing money, and there's a couple there that are still making money.
But it's been about 10 years. So the big expansion into the US, I'm trying to remember, was about 2010, I think. And so, 2010 and then 2011, maybe they were still. So, and they're mostly 10-year leases, aren't they? So now's their opportunity to get out of a lot of those, I guess.
Yeah, I mean, I think that's right. Like, it was probably coming up to time where they would have to decide on that business anyway. And I mean, there's always a reluctance to let go of floors, because you've invested a lot of money in fitting them out, and you've got to break the leases. But it's obviously becoming apparent that if you've had 10 years, it's not working. It's probably never going to work. So I think that's a good thing. That's a positive development to come out of this, and that means they can just focus on their profitable areas, which should be good. So
I think the stock's up about 50% since you recommended it, Mickey. What do you think about the valuation now?
I think it's a hold, which is as we said in the result, it is cheap, but I think it's also a business that is probably deservedly cheap. It is a risky business, even though they've managed to navigate this quite well. A lot of that's down to cost cutting too, and some of those costs will return to the business, probably as business picks up again. So in terms of the outlook, like at the moment, I think it's still got a free cash flow yield above 10%. So really, you don't need much to happen here to get a double-digit
And are
return.
they paying out
And
dividends?
they are paying out
Okay.
dividends, yeah. So the dividend now is above 5%.
Right.
No franking though.
That's
So
what
it's
comes with having a 50% shareholder.
Exactly.
Does he still
Yeah.
have 50%?
yeah, he's still got 50%,
Yeah,
roughly,
yeah.
more give or take. Yeah.
My concern, I used to be, I used to cover Servcorp and I used to own it and I used to be a big fan
Oh
of
yeah,
it.
I remember.
Yeah, well, and it used to be, 356 rings a bell actually. I think that might be where I upgraded it about sort of 7-8 years ago. Did all right for a bit. I don't think we didn't manage to sell it at the top when it got up to about $8. It just seemed like such a high quality company at the time, and as you say now, it has the look of a low quality company and priced accordingly, and that may well work out. But it's a whole different proposition to what it was. I just feel my concern is that its real competitive advantage was in serviced offices, in as much as it had that sort of high quality, the mahogany, the marble. It was just built for a world where people wanted an office in some shape or form. And now we seem to have moved to a world of shared working, which is a slightly different sort of niche. And it's, I mean, as you say, in some markets, not so much, maybe Japan, but I don't think that the brand translates that brand advantage that they had. I don't think that translates into the shared space. So So look, I think you've correctly established that it's lost its quality, but there's a price for that, and certainly seems quite cheap.
Yeah. Well, yeah, no, I agree with everything you said, and
Well, I
I
think
mean, I
it's you
guess
that persuaded me. I was Mickey a couple of years ago, so
well, I downgraded this
yeah,
actually
that's
at
right. I
about
think
about the current
I
price
think it was
2 years
you
ago.
that explained all that to me. So anyway,
Yeah, it's a good
But
example of why it's
yeah,
good to get a fresh set of eyes also on a stock,
yeah,
because we bring a lot
so
of
you can.
baggage when we cover these stocks for a long time.
that's right.
Mm.
That's right. Yeah.
Yeah. Well, and also, I mean, the thing was the reason that you got confidence around upgrading it, and probably wouldn't have, but you read Alf's AGM speech,
Mm.
and he just said, we've been through. Go and read the AGM article. I don't want to butcher the quote, but it's he
But
just
you'll
said
do it anyway.
they're
Go
gonna
on.
be they're gonna be making lots of money. They've gone through lots of these things before. They had the GFC, they had WeWork, and really kind of just having someone like that, the founder there, kind of saying our business is going to be
Mm.
fine. We're going to make lots of money this year. That's kind of what
I
I
feel
think
as though that's kind of
pushes
what
over.
Alf tends to say. I think that's his thing.
Careful, he listens to the podcast, I think. So.
Does
Oh,
he?
is he?
Yeah.
Yeah.
Well, look. Well, he's been fantastic over the years. I mean, no. Well, there you go.
Let's quickly move on
I'm
to
just.
a different stock, shall we? All right. Sorry, Mick, anything else to add about Servcorp?
No, that's it. So yeah, so we'll keep an eye on the price guide, but all going good so far, and hopefully, well, I guess hopefully the CBDs do eventually recover, and they can, find a few floors to expand over time.
Well, if Servcorp was an example of a surprise hit, the business I'm going to talk about, there was no surprises about its success at all. And Mickey, note that's the way you do segues. So BHP, of course, ran through. It's facing an incredibly high iron ore prices, so everyone knew the result was going to be great, and it was great. But for me, the interesting thing about the BHP result was digging through beyond the iron ore result. And I think sometimes with booms, a lot of investors are focused so much on the booming segment of the business, they just ignore all the other segments, even though they carry very significant weight on BHP's balance sheet. So these are big, substantial assets that aren't contributing much in percentage terms because they've been swamped by sensational iron ore earnings. And we're talking here about met coal, So BHP owns the best metallurgical coal resources in the world by bar none. A huge copper business and a significant oil and gas business. And then you've got a few other things like potash, which is they're looking at developing, and it's an interesting project. But all those assets are large, high quality. It can be extremely profitable across the cycle, and they're just not looking very good because iron ore is swamping those results. And for me, that was the real kicker. And that's what gave me confidence to hang on to BHP for longer, even though throughout most of its history, the BHP at $50 is an unusual thing and usually signals it's time to sell. But we're not in a cyclical boom at the moment. You look at most commodity prices. I mean, take iron ore out. Copper has actually gone up a lot so far this year. But that's a relatively new movement, and nothing else is really moving that much. So this is not a result of some excessive cyclical boom. I think there's a lot more to come from BHP. I think they potentially can generate really good returns from here. And it just shows how quickly the business has changed. I mean, 5 years ago, this was a genuine cyclical pig. It would make a lot of money when the prices were high. It would make very little money when the prices were low. And your job as an analyst was just to kind of navigate those cycles and pick when to buy and pick when to sell and follow the capex. It's very different now. As I've said in reports, I think this is now a properly high quality business. It's a cyclical business, but it is now well managed. Capital is well deployed. The asset base has now been finessed, and so everything they own is fantastic. It is one of the great Australian businesses, and I'm not sure it gets that recognition yet, even within the team, I might add.
I'm a big fan. The only way I can understand mining is to buy the lowest cost operator in each segment, because they're the ones who are still going to be standing when everyone else is, crushed. That sort of fits with my quality sort of approach. And I think what you're saying is that BHP basically is now that.
Yep. And it's become that by tweaking its portfolio. So it has actually shed a lot of the more cyclical parts of its portfolio. And it's also the main change has really come from a complete revolution in the way they think about capital allocation in this business. It's quite striking, and I've count myself lucky that I've seen both iterations now of I've covered this stuff for about 10 years, and I've seen BHP when it had its old capital allocation framework and the new one, and it really has made all the difference. And it really has brought home for me how important management is to any business, even a business where you have no control over your prices, where you're digging stuff up and selling it. Management is maybe the most important thing in just about any business. And that's a newish revelation for me. 5 years ago, I don't think I would have said that. And I certainly think it's true now.
So no, it just seems like it's a kind of a common theme across the mining industry in general, like not just BHP, but it seems like a lot of the miners that you cover are going through this sort of revolution.
No, you're absolutely right, Mickey. And
so who's buying all the low quality mines? Maybe they're going cheap. Maybe we should switch.
There are still lots of
the high cost mines.
Yeah, there are still lots of low quality. But Mickey's quite right. Even the low quality stuff, management across the mining industry has dramatically improved, and it kind of makes sense when the big guys move in one direction, the entire industry tends to follow. And BHP and Rio in particular led the move to focus on volume, to expand, and to not focus on cost and productivity, return on capital for more than sort of 30 years. And now that they've gone the other way, the rest of the industry has followed. I'd call out gold in particular as being exemplary. I mean, the Australian gold sector is now the best in the world, and I'm almost tempted to wade back in and have a look at some gold stocks at some stage, because they're actually...
But is that because they've closed the high-cost mines?
No.
So what's happened to the high-cost mines? Have they become low-cost because they've worked out how to do it better?
Look, there's plenty of high-cost mines still. I think the difference is that they've managed to tweak their portfolio. So I'll give you an example. Evolution Mining, we actually used to share a building with Evolution before it became Evolution. And one of the great regrets is that I never invested, even after I had talked to the CEO. Decided he was fantastic, and I don't know. I liked everything about the business, but we just never covered it because it was a gold miner with poor quality assets. But they've they do use high cost mines in the portfolio as a cyclical kicker, but they've also added better quality assets inside that portfolio, and they just manage their capital allocation much better. So in the good times, you actually get a lot of cash out of these businesses, and in the poor times, they still make profit, but because they don't take on so much debt and they don't have the capex, you don't lose as much. So the cyclical highs have been amplified, the cyclical lows have been deflated, and you just don't get those wild swings anymore. They're just better managed.
And we actually had a cyclical though, didn't we? Sort of 2 or 3 years ago. I mean, you better because I mean, all it sounds a little bit like what you could be saying towards the top
Yeah,
of the
look,
cycle.
maybe you're right.
But
maybe you're right.
but we did
yeah.
actually. But this was all tested, wasn't it? 2 or 3 years
Well,
ago.
that's
This
right.
new sort of focus on capital
Yeah.
allocation, because 2 or 3 years ago we had a bad run for
Exactly,
commodity
and that's
prices,
when the last time we
if I remember.
upgraded BHP was under the new capital framework, and the commodity prices were very low, and the share price fell. But the BHP did not it did not have huge write-offs. It didn't have the same sort of problems it's had in the past, and the test was always how would they behave when the boom was back. And I think we've seen now what happens when these big miners are flush with cash. And that's the answer is that they just hand the cash back and they buy back their own shares. There's no longer this imperative to grow at any cost. And that's a good thing for the industry. So I've been really happy with BHP's results in particular. I would say Rio, when you look past iron ore, Rio Tinto really disappoints. And I worry about that asset base. They've not paid enough attention to that asset base. And I think there is more pain for Rio once we come to the other side of this iron ore boom. Whereas BHP, I think BHP can actually protect the earnings that have grown with iron ore because of all the other assets underneath it. But I think that's enough of BHP and mining. Gents, any questions or comments on those? And you guys wouldn't own BHP, would you?
Interesting.
It's a huge chunk. I think BHP is the single largest position in our growth fund at the moment.
Is that's because largely due to its performance?
Yes, and also because we haven't sold it. Every time I get a note from Nathan, should we sell now? Should we sell now? We have to tell him no, don't sell.
Yeah. Well, I guess the other key with with BHP is just how long their assets are meant to produce for, right?
Yeah.
So they're just they're almost like I don't want to say like a bond, but like they're just depending on what the price is, then and if they don't change it too much, then it's pretty predictable cash flows, really.
It's been pretty ever present as well, hasn't it, in our portfolios? I mean, we bought it. I remember you upgrading it around $30, and it promptly sort of fell to about 15. Along with everything else. When was that?
That was I think 2016, and that was when they had that big dam collapse.
That was the big. Well, yeah, that's right. But that was also a big. That was the big commodity collapse, wasn't it? And and I suppose what that tells you. So it's about $50 now. What that tells you is that you can just ride through these things a bit. Because I mean, we originally upgraded it about 30, and then kept backing it all the way down, and so hopefully some people picked it up at cheaper prices.
Yeah, and you've got really good dividends all the way throughout, and that's great. You can actually, I think the dividends would make a huge chunk of your returns if you did that calculation, which we should do at some stage as well. But yes, so very happy with BHP's performance. JC, you got another stock for us?
So the next one I was going to talk about is Altium, which not such a good result, but quite interesting. The way Chief Executive Aaron Merkazemi described it was that the company's been in a pit stop in the last 6 months, which there's always a bit of a worry when a chief executive says
analogies.
That. He does. He's gone into motor racing. He was on
cricket last time, wasn't he?
Before. Yeah. Well, he's been on cricket for a few years.
Right, and now he's gone to motorsport.
I think he switched to motorsport, which is good. But it does kind of describe it. What's been going on pretty well. So they've been whizzing around the track, and getting lap records, and you can take this a little bit too far. But with the pandemic, a few of the things that they were going to be doing anyway, they've pitted a little bit early perhaps, and they've gone and sort of done them anyway. So they've reorganized their sales process, splitting it into two channels. One for low touch digital sales, and one for the sort of high touch, high end customers, which need a little bit more mollycoddling to get them over the line, and they need a little bit more integration and all that sort of thing. And they've also established a new business unit, which they're calling Nexar. Now, I suppose to explain that, I need to backtrack a little bit. So they make software to help people design printed circuit boards, which are the little gizmos that go into most electronic products, the plastic sheet with bits on them, the resistors, capacitors, chips, and so forth. And so they made the software that helps people design these, but and they've been increasing their market share up to they're getting pretty dominant now. And so with that dominance, the plan is to transform the whole industry, because at the moment the situation is that the person who's designing the PCB, they need to talk increasingly with the way electronic goods are going. The design of the overall mechanical design is increasingly important as well for things like wearable devices, Fitbits, that sort of thing. It's a matter of getting the PCB small enough, in the right shape, all that sort of thing. So in order to get the PCB designers to talk to the mechanical designers, and also to talk to the people, the availability of components, and then the final manufacturing of the product, all of that needs to be combined in the design process. So they've launched something called Altium 365, which is a cloud environment whereby you can put your design easily from Altium Designer, the design software, and people in the other, the mechanical designers can easily go in and look at it, and make suggestions, say, you can't do that because I need it to be smaller or whatever. You can also see what the availability of parts is nice and easily. They've bought a business called Octopart, which is an online component search engine, which fits nicely into it. And they're also developing a small smart manufacturing business, which also sort of ties into that. So it really brings all of those processes together, and helps the industry, the overall PCB design and manufacturing industry, communicate. And so they've established this new business unit. So they make the design software, that's a separate thing, and they've established this new business unit to deal with all the other stuff. So Octopart, the search engine, the component search engine, and the smart manufacturing business are now being moved into Nexar. And the way he describes it, they now have they've moved from having one growth engine with one flywheel to having this is where the metaphors to two growth engines with four flywheels.
So is that a double or a triple in the share price?
Well, it's been a 30% fall so far, or a 20% fall.
Need less flywheels. That's too many flywheels.
Well,
it's back a bit.
Yeah. I mean, look, but this is the thing. I mean, he some of their releases, Altium, are a little bit promotional, it seems at times. But I like that he's enthusiastic. I like that he's got a plan, and I actually like that he uses some imagery. He makes an effort to try to explain it to people, and I think that's important to to the market. But who cares about that? Long term, what matters is what happens to the business. And internally, I think I'm presuming that he's describing it in this way to staff as well, and I think it will help them understand what they're all trying to do. They'll know that they're part of a particular flywheel. And the idea is to get those flywheels spinning as fast as possible. So the dominance engine is based on based on the PCB design software, and has those two different sales channels. So one flywheel is the direct sales, and then the other is the high touch sales channel, and then there's the transformation engine, which has Altium 365, the cloud tool, and this new division Nexar as those two flywheels. So the staff within the business who are allocated to each of those units, they know that what they're doing is important, and they know what part they play. Spin very fast. So I think it all makes sense, but it's caused a few difficulties in the short term, because having split so they were discounting heavily their product, Altium Designer, during the pandemic. But having split out the sales channels, they decided they didn't want to go back to discounting, because it would just sort of flag the discounts to the high touch channel, which wouldn't be very helpful. So when the second wave of the pandemic hit in the Northern Hemisphere, they found themselves really without the option of going to discounting. So that slowed things down
as
a little
well,
bit.
though. I feel like sometimes with promotional management teams, the risk is just that they're not telling you everything, and so like if it could well be, as I've said, and I guess in this case, Merkazemi owns a lot of stock, but do you think that's maybe why the share price is down? Like people are just doubting what they're saying, or?
Yeah, I think so. I mean, look, it's a pretty messy result, and a lot of this is in the future. So it's going to be to do with execution, but they've executed very well for the last sort of 7 or 8 years. I mean, Merkazemi, he came into the business, that his business was acquired by it in, I think, about 2011, and ever since then, he's executed beautifully. And I would back him to keep doing so. You can see the glass as half full, half empty.
JC?
I see with him that it's very much half full. So that's, I suppose, the point. You either back him or you don't. I find that I like that he has a plan. I like that he's and also he's technically very strong. Of course, his background is in all of this, and I think it's great that you have a chief executive who has a background of actually really deeply understanding the product.
And very, very aligned as well, I guess, in shareholding and.
Yeah,
well.
but I get the feeling that he doesn't really care about that. I think he wants to build something great. I don't think he's particularly. I think the money will come. I don't think he is particularly motivated by that. I think he wants to build something great, and I think I would back him to do so.
JC, just confirming, you upgraded Altium as the stock fell post-reporting season, correct?
Yeah, that's right. So the buy price is $30, and it's been $30 since right at the beginning, despite the share price. It's been down. It got down to $23 in the. So we upgraded about 27, 28 with a buy below 30, and then it got down to 23 in March last year, and it's been as high as about 40. But ahead of the result, I think people, knew what was coming, and so it did slip below $30. But we didn't upgrade straight away because we just wanted to see the result really. But the result came in, and it all looks like it's proceeding to plan to me. So we were happy to upgrade it around about $29 after the result, and since then it's slipped to sort of 25, 26, and still very comfortable with it. I mean, it's very expensive, right? That's the other thing to understand with Altium, is that it's it's on a forward PE of about 60. It'll be a bit less now, but so that shows you. I mean, the market, really, there isn't much dispute in the market about the potential that it has, and so when you ask Mickey whether people are doubting it, I don't think people are doubting it so much. I think people are just slightly concerned about how long it all might take. I suppose there's slightly more risk with the long-term growth plans, or that's what the market's thinking, but also there's the interest rates, right? So with bond yields almost doubling in the last 3 or 4 months, high growth stocks, with their earnings way into the future, they've suffered a bit. and Altium would be one of those. So I think it's a combination of those three things. But make no mistake, it's still an awful lot is still expected of it. But I'm confident backing it. I own it myself, I should say.
Very good. Mickey, what do you got for us next?
So I thought I'd talk a bit about Omni Bridgeway. So we've got an article going up on that. It's been written, so hopefully that goes up before this podcast. So
I'll do
yeah,
my best, Mickey.
well, it depends how much work you have to do to it. So I got started on it pretty early in the morning, so there may be a few mistakes in it, but there was so this result. So obviously Omni Bridgeway is the litigation funder and fund manager. So that means that they go and they fund court cases on behalf of claimants who find it a bit risky or can't afford to actually pursue these lawsuits themselves. They've got a great track record of doing it, and they're now building a funds management business. This was a very ugly result. So a big loss, basically, and the reason for the loss, it's mostly an accounting issue. Well, not an accounting issue. It's just it's an accounting loss, not necessarily an economic loss. So we need to unpack it a little bit. But basically, the way that these cases work is that obviously they've got really long, dated outcomes. So you start a case today, and you might not know what's going to happen to it, for another 3 or 4 years down the track. So you can get these situations where, and this is what happened in this result, you get a couple of maybe unfavorable outcomes from cases. One of them was dated all the way back to 2011, actually, in this result. And it just so happened to be quite a big one. It's the Westgem case, which led to a $50 million write-down because of an unfavorable outcome. So this business model is prone to lumpy results where you get kind of clusters of cases and they complete in certain halves. Realistically, like a 6-month result just isn't the right way to think about this business. You need to think over like a 3 to 5 year time horizon, which is about how long the cases take to complete.
Is it safe to say, Mickey, that accounting, market-derived accounting, doesn't really suit this company at all?
Yeah, I think that's right. But I mean, it would be very hard to devise a system that would kind of accurately, because you don't know what's going to happen to the cases until you get the judgment. So and assuming the probabilities of success and all that stuff is just impossible. So
just explain. So the cash flows out. You pay lawyers for 3 years or whatever. And then hopefully get a judgment, so there's a huge investment, I suppose. There's a long investment cycle.
Yeah, so there's basically the costs that go into the case, specific costs that go into the case. That all gets capitalized on the balance sheet, and so you've got these big intangibles, and basically when the case comes to completion, if it's an unsuccessful case, they write down that investment, and whereas if it's if it's successful, they de-recognize it and then they record income.
But they only capitalize the cost of the case. They don't capitalize any success damages that they expect. So even if they think they've got a cast iron case, I suppose if they think they've got a cast iron case, the other lawyers will think so, and it'll settle pretty quickly.
Yeah, so I think the accounting in this business is very, very conservative because they don't assume like any gains before they've come. Whereas when in reality, actually, a lot of these cases will be worth a lot more. So the net assets are basically understated, I guess you can put it that way. Yeah, but I guess just kind of accounting aside, because that's kind of, it's all just, that will kind of ebb and flow, I guess, over time. So the thing is that, so the result was basically just that it had a couple of bad outcomes. They could reverse those outcomes if they're successful at appeal. But I think it's not necessarily something to worry about, because these results will happen from time to time. And I think what they're basically looking to do, is transition the business away from this kind of lumpy, profit loss cycle, by transitioning to this funds management model, and that will allow them to collect regular management fees, that should hopefully cover their operating costs over time. And then you'll still have some lumpiness as cases that it's unavoidable, but it should hopefully become a much smoother, steadier.
So they make co-investments in all these funds, and so that's where there are some write-downs, right? And also they still have some cases on their books from before they began the funds management
Exactly.
strategy, right?
Yeah, exactly right.
So it's
Yeah,
those cases that are sort of rolling off, and two of them that they own entirely, the rights to, as it were, they fell off.
Yeah, exactly. Yeah, and they're kind of right in the middle of this transition now, like with this kind of legacy cases just rolling off, and also at the same time their costs are ramping up because they're expanding globally. They're building out this funds management business, so you've got kind of rising costs, you've got these lost cases in this result, and then the funds business hasn't really kicked into full gear yet. So so I think that's all just contributed to a bad result. But this is part of the opportunity. This is why we think it's probably being missed. And so I mean, if they get to that $5 billion FUM target, then earnings should be pretty
I
good.
agree. It looks very cheap. The management have generated amazing returns historically, but geez, it's complicated. There's very little like this on the market, and I can see why a lot of people and fundies would just miss this. It's you have to know this business really in depth to understand these numbers.
Yeah. Well, hopefully that's the opportunity. And the only other thing really of note, I guess, is just that they bought this Omni Bridgeway Europe business. So this company used to be called IMF Bentham, and then they bought Omni Bridgeway in Europe, and changed their name to Omni Bridgeway because IMF was apparently, they got confused with the actual International Monetary Fund.
Or the the spy agency from Mission Impossible is also called IMF. I always confused it with that, actually.
Oh, right, okay. Yeah, so they decided to change the name to Omni Bridgeway, but so this acquisition now, the European acquisition, gives them expertise in like recovering post-judgment outcomes. So, if you win a case, making sure that, the other party might like hive off their assets into like a complex trust, in the Cayman Islands or something, and then you can't get it out. So these guys are like private investigators, and they come from
send the boys around. Is that
not too far from Mission Impossible?
Send in the goons.
Sounds a bit worrying.
Well, yeah, but I mean, it's a
they're
really
lawyers
hard
that they're
thing to
sending
do.
around more than anyone.
That's scarier than
private investigators.
They're not out breaking people's kneecaps, hopefully, but but this basically opens up a new line of business for them, because now they can fund more cases. But they are funding cases now where they were worried they couldn't actually recover them, whereas now they can go and they can fund those cases because they can go around, send the goons around.
Nice, Mickey. All right, let's finish off with Aussie Broadband, which is the one I wanted to bring up. This is a relatively new listing, new recommendation. This is actually, I think, the first IPO we've recommended. JC, help me out here, in years, right? Certainly the first one I can remember.
Well, but the thing is, though, we didn't actually recommend the IPO because we did.
No,
did we at $1? But we didn't. I think that we didn't. Did we? We couldn't put a rego
no, because
on it.
No one could get stock.
We ended up putting a rego,
Yeah.
and no one could get stock, and then the price. This is the problem. Any decent
true.
IPO, you can't get stock.
But still, we wanted to. I mean, even that.
Yeah, we wanted
unusual.
to. We told everyone we wanted to. So that it's the thought that counts.
But it's not usually our gig, right? We don't there's been lots of hot IPOs, and we haven't tried to get in.
Normally, I mean, it's that Buffett quote, isn't it? That the IPO is when the seller has all the information, and the buyer really is just a goon.
Now, just a reminder, Aussie Broadband is a reseller of NBN, so it offers broadband to retail and enterprise customers. It's been in business for a long time, I think, 15 years or so, maybe longer than that. So it's not really.
I've got to interrupt you for a second. I've got to interrupt because tell everyone that Gaurav is right now speaking. You can hear him. He's coming through to us via Aussie Broadband.
That's right.
So you can judge the quality for yourselves.
And that will be the cue for me breaking off, I think. Surely.
It's
happened. I think it's happened earlier today. It did actually fail, but that's unusual. Yeah. It's quite a good service as a customer. But the reason I was interested in this was I just heard a lot of separate reports from people in the industry about how good this management was, about how good this business was. So that piqued my interest. And then when I saw the terms of the IPO, that not a single insider was selling a single share, that money was being raised for a specific item, namely to build their own fiber network. I mean, that ticks a lot of boxes already. So it was a very easy stock from my point of view to upgrade. And the results were just fantastic. The first year results were just great. It was only the interim, so it's not a full year of results yet, but they are already smashing their prospectus forecast. No doubt COVID has helped because people working from home tend to maybe expense their broadband costs.
Well, that's right. And everyone starts working from home and they suddenly think, goodness, I need to upgrade I need to get better broadband.
And maybe the company will pay for it, a little bit of it, or they can at least tax
deduct
it.
But then you retain those customers, so that's a permanent.
Their churn is really low. I don't recall the number, but I remember thinking, wow, that is low. So they don't lose a lot of customers. But what I really like about this, the reason this business works, and no one makes money from reselling NBN. Telstra makes no money from it. Even TPG, who is ferociously efficient on costs, they make a small margin on it. But these guys are doing really well because they don't compete on price. They are often the most expensive providers in the segment, but they balance that high cost with very good service. And service doesn't just mean saying please and thank you on the phone. They've actually developed a whole lot of software and a whole lot of technology to make the entire experience really, really good. So the onboarding is the quickest in the industry. It takes, I think they said less than 60 minutes to onboard a customer, which is faster than anyone else.
Is that what you
Absolutely. And mine was 15 minutes onboarding. And
so you mean on the phone to actually being
to get it started,
to having the order
correct?
Complete. Yeah, okay.
Yep. And without any touch points at all. So the whole thing is automated, extremely unusual in this industry. The customer care, all the billing, the service, a change of plan, change of anything is all taken care of by automation. And what I really like is that they are looking now to build their own fiber network. So they'll supplant rental costs with their own network, and they can scale just a little bit better. They'll be able to raise margins and offer different products and services once they have their own fiber. And they've built an enterprise portal as well, so they can actually sell a whole bunch of enterprise services now to large customers, which is often a source of big revenues and big margins for competitors, so they can now enter that space. I think there is a whole bunch of growth here coming for Aussie Broadband. They've got about 4 or 5% of the market at the moment, tiny. And this is never going to be a mass market product. They're never going to get 50% of the market because they're very expensive. But they could easily get 10%, 12% of the market. And when you look at the market shares, 40% of their customers are those ultra-fast, high expensive customers who are profitable, compared to 12% of customers for the entire NBN. So they're attracting heavy users who pay a lot of money. And that explains why they're able to make money out of a service that no one else can make money out of. They're actually collecting the profitable niche customers from everyone else. And it's a great space to be. Management know exactly what they're doing. The guy who runs this business lives and breathes it. He's done 3 iterations of this company since he was a teenager. And he's just a great entrepreneur, and I think it's definitely worth backing. He hasn't sold a single share.
So my concern with this, right, is that so you just touched on it there. So how big a market share can they really get? If they can get 10%, I think that's probably conservative, by the way.
Well, it seems like they're taking share off Telstra mostly, because Telstra's more that premium end, perceived, I guess. Yeah.
But how many people are going to pay, the premium rates for their broadband? I mean, that's to me the question. Whether it's, I mean, I suppose if it was 20%, then that's a different, because what you said, there were 4 or 5% now. 10% is just a double in terms of that. Now, obviously, they can get a bit more margin and slightly higher ARPU and that sort of thing. But just a doubling in their market share. To me, sounds a little bit because the market's not really growing, right? That's the point.
Well, and I wonder is if Telstra as well, the other companies are watching this, and they're probably going to react or respond if they can. Maybe it's too late, but
it's a fiercely competitive market. There are about I think I counted about 100, between 90 and 100 different competitors, but there's always been 100 different competitors, and Aussie started with 0 market share in regional Victoria, and they've grown and grown. The way I thought about this, and James's point's absolutely correct, that this is no obvious moat in this business. It's a competitive industry with no identifiable competitive advantage, with powerful incumbents, and you'd think a relatively small market opportunity. But I would flip a lot of those things around, and I think this management has shown that they can grow a business against fierce rivals in a competitive space from nothing and be one of the few people in the industry to make margin from it where no one else can. And for me, this broadband is just what they're doing today. I can see that they're clearly laying groundwork here for lots of other products and services to come.
Now
we're growing the market. So what are we thinking?
So they mentioned that they made an MVNO agreement. That means they made an agreement with Optus to use Optus's 5G network for additional services. Now, they didn't specify what they're doing with that. I don't think they're just selling mobile plans. That might be part of it, but it looks like they're offering fixed broadband and 5G backup for fiber in case the NBN fails, which we know it can do time to time. So they're doing that. They're building their own fiber network. That opens up to dark fiber connections the way TPG does. Remember, TPG makes 50% margins, a third of its profits from dark fiber connections. So it's a wonderful business. This is the first step towards creating a dark fiber product, which is building your own fiber network. And it's only a small one. They're connecting capital cities and data centers with points of interconnect, which is where the NBN meets. But that is a necessary first step. I don't think it'll be the last step. I think there are big ambitions with this business, and if all it did was just to grow market share to 8% or so, I think I did the numbers in one of the reviews. You end up with a business that can make maybe $50 million in profit, and it's a $400 million market cap now, which is fine.
So that's not bad.
I think it caps your downside,
and you're getting the rest,
and you get a lot of interesting upside from here.
Although you're assuming there that it doubles its market share, but I think that's almost.
I think it is a given.
Given the quality of the product, it sounds. Yeah. And I do think they've got some competitive advantages. I think that the management is obviously very good. I think that they're the brand and the way they're perceived by people. But it's just a question of where they can go with that market. And I suppose with a lot of good companies, you can never quite be sure where they find that extra.
Remember, TPG started as a hardware reseller, and look where it is today. I think sometimes when you find these exceptional founders, you don't want to pay silly amounts for their ambitions. But I don't think we're doing that in this case, and we are on board for whatever this guy can conjure up. And I think when you weigh up that sort of upside and downside, it kind of makes sense even at this price.
Yeah, that's right. You're getting that ambition for free. With Altium, for example, you're paying an awful lot for the ambition, but the ambition
is grand.
It's slightly different. I was just thinking there. There's actually a clear plan for it. So I suppose it's slightly different. Situations.
But I still think Aussie Broadband's gone up a long way since it listed at $1. I think we recommended it at about $2, up to $2. and it's now what 270, 280. I still don't think it's crazily priced, and for risk tolerant investors, I still think there's some. It still could make some sense.
Yeah, you did great picking it out as a float, as you say, but it's not our normal hunting ground. So to have at least covered it from that point and then upgraded it when there was an opportunity, I think it's a great one. I wish I'd have paid attention to.
Well, I'm glad. I remember the Dragon's Den was quite contentious, because I think it's one of those things where it's very easy to make a bear case for.
Well, I think we were all on board at $1.
Yeah, exactly.
I mean, that was the thing.
We're all on board
it's a question of where it was going to get to after the float, and I think the upgrade at $2 was harder to justify than if you could get it at $1. But look, I think you made the case, and I think it's going well.
And so far, the product hasn't dropped out, so that was good. It would have been awful to see a dropout while I'm talking about how great the stock is.
Well, speaking of, it sounded like you were just.
Maybe we should. Maybe that's a sign.
We better wrap this up.
I know.
Sponsored by Aussie Broadband.
Now, gents, we'll do this again next time. I think we got. We're going to actually hear from our Canadian office on the next podcast, so a special treat involved there.
Exciting.
Yeah, I'm really excited. I know, I can't wait.
Hey.
Haven't decided what we're going to talk about yet, but I've got some ideas.
Oh, he's got plenty.
Graham is maybe
all his stocks from reporting
the most knowledgeable person on CSL you'll find. So I think it's when you get him sitting down, you can't not really talk
certainly
CSL.
Talk about that. Yeah.
All right. Till then, JC, thanks very much, especially for bringing up Domino's, which I just think I love talking about that business. Fantastic stuff.
Don't say bringing up Domino's. That's too much.
That's too much. And
all right.
And Mickey, thanks very much for your time as well.
Thanks. Cheers.
Everyone else, thank you for listening.